Hello, Nebraska, and welcome to this week's edition of the Retirement Compass, the show that's dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have two members of Stonebridge Wealth Systems based right here in Nebraska. Tim Kulhanek is the co-founder, and Jeremy Gove, who is a partner. And today we have a wonderful show for you, jam-packed full of helpful information to make sure that you don't miss out on what your retirement could look like, because the number one detriment to folks' retirement is often their hidden tax bill in retirement. So we're going to talk about that today. It's actually going to be a top 10 list, if you will. You guys have put together a potential real highlights, if you will, of ways tax saving tips. So Tim, Jeremy, great to be with you.
Yeah, good to be back. Thanks, Kristen.
You're welcome. Well, it's great to be here with you, and I know you have a lot to get into, so let's just get right to it. Let's dive in with the first one. So Tim, this is going through kind of a top 10 list of potential tax savings that folks can engage in. What's the top of that list?
Yeah, good question. So what I thought we'd start with is something that applies to a broad spectrum of folks, and that is tax advantage retirement savings accounts. I think it's good just to remind folks that every year the limits for these types of plans can change. So we're just going to give kind of an update. So if our viewers out there are wondering, well, does this apply to me? This would be things like 401ks or 403bs, depending on the sector you're in. If you're a government employee, it might be a thrift savings plan is what they call that, or TSP.
457s, right?
457s, yep. Absolutely. And so those are what we call employer-sponsored plans.
Right.
And then there's the other side of the retirement plan kind of spectrum, and that would be IRAs. So that's an individual retirement account. Sometimes this might seem kind of simple, but people forget that the I in IRA stands for something, individual, so you can't have a joint IRA. So we're talking about each individual person. And so what I wanted to do is just quickly give our audience an update on what the numbers look like for 2024, and then we'll update this every single year. So for example, I wanted to make sure I get this right. So for 2024, the contribution limits, if you're under age 50 and you're contributing to or you're eligible for a 401k or 403b TSP, that type of plan is $23,000. Now, what the government does is once you reach a certain age, they give you a little bit more flexibility. They say, hey, you know what, maybe you were like a lot of folks and you weren't in your highest earning years early on.
You didn't start when you were younger, right? A lot of folks have that regret.
And you can only stretch a dollar so far. So when you're raising kids and you're buying diapers and formula and all the different things that come with children's expenses, I don't know the exact numbers, but I know they're expensive because I got a couple of them. You maybe couldn't put as much away. So they give you what's called a catch-up contribution. So in 2024, that's $7,500.
So once you're over the age of 50, you can put away even more.
In fact, in the year you reach age 50, that's when that trigger occurs that you can put that additional in. Now for an IRA, it's $7,000 if you're under 50. Once you reach age 50, it's an extra $1,000 for a total of $8,000. That could be a traditional IRA, which again for our viewers, that's a pre-tax account, or a Roth IRA, which is going to be a post-tax account. Think of the traditional IRA as kind of the taxed forever. You're always going to, again, it's tax deferred. Very nature of the word deferred means later. A Roth is tax exempt. It's tax never. So you pay the taxes on the money you earn today. You'll never pay it again. So if you put $8,000 in a Roth IRA and it grows to $80,000 over time, not saying that we have an investment that's going to do that right away, but if that happened, you wouldn't pay any taxes on that growth. The last thing I want to mention, in order to contribute to something like an IRA, you have to have what's called earned income.
Yes.
Okay. So it's not just, hey, I'm on Social Security and I've got a pension, I'm going to put money into an IRA to get a tax deduction. It doesn't work that way. It has to be W-2 wages or self-employed income.
Right. Well, I'm glad you're preferencing all this. And again, those limits have changed. Every year they've been going up. So it's important to know what those contribution limits are. Also, for your employer-sponsored plan, that money has to go in for that calendar year by December 31st. With your traditional IRAs and Roth IRAs, you usually have until the tax filing date of the following year if you want to make a contribution,
That's a good point.
So it's important to know that that's on the top of a lot of folks' minds. All right. Well, Jeremy, what's next on the list of tax-saving tips?
So this is actually one of my favorites. We're going to talk about HSAs, so health savings accounts. And the reason that I like health savings accounts is because it's the only investment that you can make or savings that you can make where it's triple tax savings. So
explain that, because that's huge.
Yeah, it's really important. So you don't pay taxes when you put the money in, so you deduct what you're putting in. It grows tax-free, and then as long as you use it for a medical expense, which is a pretty broad range, so it could be even Band-Aids and stuff like that. As long as you're using it for medical expense, there is no tax on that money. So That's one of my favorites. And like Tim mentioned, just to go over a couple of numbers, just to make sure I get this right. So for deductibles, to qualify to contribute to an HSA, you have to have what's called a high deductible health savings plan or a high deductible health insurance plan. And so with those deductibles for an individual, it's $1,600, and for a family, it's $3,200. Those are the minimum deductibles that you can have to qualify you for an HSA. And that's really important. And so the contribution limits, those also change like the other types of limits each year. So as an individual, you can put in $4,150, or I'm sorry, as a family, you can put in $4,150, but if you're over the age of 55, you can put in $5,150. You get that extra $1,000 as well. The other thing that's really important, a lot of people have savings accounts or FSAs through their employer.
The flexible
spending accounts. And so they're putting money into those, but that's money that you have to use by the end of the year or you lose it. With an HSA, that continues to grow. So it's not something that you have to use it or lose it. Next year I can put in additional money. The next year after that I can put it in. And so it's something that you can continue to use. And eventually, if you get a large enough balance, it's something that you can even choose what you want to invest in. So companies like Fidelity and Schwab and these other places will provide options for your HSA funds. HSA accounts.
And would you say that's one of the most underutilized tax saving things that people have available to them? Because a lot of times folks just don't even understand how they work.
Yeah, it is. And there's a little bit of, sometimes I think people are used to a traditional health insurance where you have a deductible of like $1,000 or $1,500. So when you bump that deductible up, I think sometimes families get a little bit nervous because that max out of pocket may be more than what you can contribute to the HSA. But for the long term, if you're looking long term, it's definitely a tool that you should be using.
For sure. Important to know the ins and outs of it and how it works and if it could benefit you. Well, we have time for probably a couple more, maybe one or two more in this segment. So Tim, what are some other tax saving strategies, not just for 2024, but for beyond?
So here's what I found. When folks come in to see us, a lot of times they're in a situation, this might apply to a lot of our viewers out there, is you worked really hard during your working years, and one of the goals that you had was to have all of your debt paid off by the time you retire. So during our working years, we've got a lot of things that we can deduct or credits that we receive from the government, from the IRS, for example, the tax code. So for example, Jeremy has children, I have children, we get a tax credit for that. I'm paying on a mortgage, so if you've got interest, you can deduct your mortgage interest. We talked about some of the other deductions that with the health savings accounts and the IRAs, but if we're retired, here's what happens. You got your house paid off. The number one deduction on what's called a Schedule A, if you itemize your deductions, is mortgage interest. Well, that's no longer available because you paid your house off. Congratulations. That's great, right? Kids are grown and out of the house. No more child tax credit. Don't have any more earned income. Can't put it into an IRA or a 401k. So where are we at? We're kind of between a rock and a hard place. So the good news is the government, in their infinite goodness, gives us something called a standard deduction. Now this changed quite a bit with the 2017 Tax Cuts and Jobs Act. Those rates kicked in 2018. There's a sunset on them. We'll talk about that a little bit more. But it's basically almost doubled what the previous standard deduction was. So now we've got the majority of people, I think 70+% that just take the standard deduction that don't itemize. So for 2024, here's the numbers. Single is $14,600. Married filing jointly is $29,200. And then if you're filing what's called head of household, that's $21,900. It's important to note that if you're 65 plus, they give you a little bit extra. So there's all these different numbers. We've actually at Stonebridge developed what we call a retirement calendar that people that can call in, that can actually get a copy of this complimentary, that'll just show you these key ages of when can I put more in, when can I take money out, when does this penalty go away, when am I required to take money out. But this one is age 65 plus, and you'll get an extra $1,950 added to your standard deduction if you're single. If you're married, each couple, once they're 65 plus, gets an extra $1,550. So to really simplify this, if you're married filing jointly in 2024, your standard deduction, don't have to itemize or keep track of any invoices or anything, is $32,300. That's a big chunk.
That is huge, yeah.
So what does that mean for all of us? It means you don't have to file a Schedule A unless you're making big charitable contributions. The reason you'd file a Schedule A is because you have charitable contributions, mortgage interest, student loan interest, state and local property taxes up to $10,000, and then large medical expenses. But I think the key for our listeners is this, our viewers is this. a lot of times we just go about our lives and do things the same way because that's just how we do them. Think about where you go to church, where you sit. Like, I know you all sit in the exact same spot every Sunday, right? Or at least the same area. Growing up in Kearney, First Baptist Church, before they moved over to the former Kearney High School, my parents and I would always sit in the back in the blue chairs, right? And you had to make sure you got there at a reasonably good time because otherwise you're going to be behind a pillar and you wouldn't be able to see Pastor Stan, and so you were just in listen-only mode. A lot of times with our finances, we just set it and forget it, and we don't keep up with the changing times. Some of the things have changed. The game has changed. The strategies have changed. So things like qualified charitable distributions have come into play, where you can actually give money to charities like your church a lot more efficiently. Rather than writing it out of pocket and still taking that standard deduction, which you don't really benefit from a tax perspective, that contribution, you can actually start giving money out of your retirement accounts and avoid the tax altogether. So kind of almost like double dipping. We want to make sure you're taking advantage of that. The key is you have to work with a team of advisors that understand how these rules work and keep up with these changes. The good news is your team here at Stonebridge has done just that. So we invite you to give us a call and get started today.
Tim, Jeremy, such wonderful, helpful information. I know we are just getting started, but if you would like some help building in these tax saving strategies into your financial life and your financial plan, what the team of Stonebridge Wealth Systems are offering you today is a complimentary written financial plan. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. To claim yours, we encourage you to pick up the phone and call 866-256-7778. Or if you'd rather not talk to someone right now, but you do have your smartphone handy, if you simply pull it out, you can open up that camera app, point, click, and scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary visit that way as well. Don't go anywhere. We've got more tax-saving tips for you. Stay with us.
My story started when I was in college. I was trying to figure out what I wanted to do. I knew it was going to be in the financial industry. I took a lot of accounting and finance classes. I thought I'd probably work in like a bigger company and work my way through maybe the accounting department. But then when I was doing a internship the summer before my senior year, I walked into a business. I was trying to sell magazine ads. I don't know if I call it magazine ads, but basically ad space in the back of the UNK student handbook and planner, which was a difficult sell because, nobody uses pen and paper planners anymore, at least not college students. But I made my best pitch to some financial advisors. I happened to be Scott Noctegal that I met with that day. When I went for the close and tried to see if he was ready to sign up for some ad space, he said, yeah, no, I'm not interested in that, but it takes a lot of courage to have somebody to be willing to walk into a business, especially a business that really doesn't cater to your target audience, to put yourself out there in a way that the odds of you being successful are probably pretty low. That's the type of person we'd be looking for at our firm. Have you decided what you want to do? And I said, no, I really haven't, but I only want to work with finance because I like numbers, and math's always been my favorite subject, and working with kind of complex equations, almost like a puzzle. And so that's really where it all began.
Welcome back, Nebraska. You're watching The Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, here with both Tim Kulhanek and Jeremy Gove. We are talking today about tax-saving tips and strategies for you for not just 2024, but beyond. We want you to have a successful retirement, and certainly focusing on lowering your tax bill and burden in retirement is key to that success. Yeah. Tim, you mentioned in the last segment QCDs, those qualified charitable distributions. Can you explain a little bit more about how those work and how our viewers can take advantage of them?
For sure. I mean, they're really, really cool, to be honest with you. It's a great strategy. So basically, you can actually donate money to charitable organizations out of your retirement accounts, out of your IRAs. So think of like a traditional IRA. So let's say you work for a company for 30, 40 years, you roll your 401k over to an IRA, you're taking distributions, and this 2017 Tax Cuts and Jobs Act hits, and all of a sudden the standard deduction goes way up. You're still giving money to charity, but you're not getting an additional deduction because you're no longer filing that Schedule A. Instead, why not just redirect some of your distributions from your IRA to go to that charity? That becomes a non-taxable event. You'll still get a 1099. You just got to tell your accountant, hey, this was a QCD. So your 1040, you'll still have that dollar amount that distributed. If you give $10,000, it's $10,000 as part of that distribution, but you'll write QCD. So the taxable amount's going to be $10,000 less than what the full distribution was that you took. And you can give up to $105,000 via QCDs in 2024. Quick example, so this literally just happened the other day in my office. Client came in, then they were lamenting the fact that they give like $7,000, I think it was maybe $7,200 per year in charitable contributions. And they're like, yeah, we love supporting these charities. Of course, it's meaningful to us and something that's close to our heart, but we don't, actually it's $12,000, there's my number, but they don't get the deduction because they're not filing a Schedule A, because again, $32,300 is that standard deduction.
Right.
I said, well, have you thought about using QCDs? What's a QCD,
Right.
And so we had that discussion. Long story short, they're at the 22% bracket. That's their effective marginal rate. That's where they're going to pay on the next dollar out. They'll save $2,640 this year in federal taxes, another $720 in state tax. So we just put $3,300 back in their pocket just by using a better strategy, redirecting where those dollars are coming from. The charity's still getting paid, but they're getting paid out of a more tax-efficient distribution method.
Yes, and it's important to note it has to transfer directly from the account. You can't withdraw the money and then give it to
The
the charity,
charity, go direct.
otherwise it doesn't count.
Thank you, yeah.
And you need to be over age 70, right? So
You have to reach age 70 and a half. So
70 and a half,
in
yeah.
order to achieve that, and it's not like, oh, the year I reach age 70 and a half, it's you actually have to be 70 and a half or it's disqualified. So again, this goes back to the end of the last segment where you have to work with a team that knows all these specific
the ins and
dates,
outs,
because
yes.
I can tell you the IRS isn't going to say close enough.
Right.
It's not going to happen.
And the IRS is also going to call you and say, hey, just so you know, you can save paying us some money, right? It doesn't work that way. Well, I know you also work with a lot of small business owners. You have a huge clientele in that space. So Jeremy, what are some tax saving tips and strategies for folks that are in that category?
Yeah, so that's a really important one. And like you said, we do work with a lot of small business owners. And I think the tax savings can actually occur when you're setting up your entity. So how you're set up can have a big impact on how much taxes you pay. So for example, you can be a sole proprietor. So a farmer may be a sole proprietor, or maybe you're a dentist and you don't have any employees, or you're whatever. Basically, a sole proprietor is somebody there's one person involved with that business. Lawn mowing business, most likely would be a sole proprietor. So as an example, and you can be a partnership. And a partnership can be set up in multiple ways, but you're going to get different tax forms as being a part of a partnership. Being a business, obviously there's a lot of things that you can write off, and so there's a lot of advantages there. Corporations, you can do a subchapter S or a subchapter C. Most of our clients that are small business owners, I would say, end up in that subchapter S, or they're striving to get there to get the tax benefits. And so one of the big things that we talk a lot about with people, if you are a subchapter S, you can take income as W-2 income. So you're going to pay taxes on that. You're going to pay FICA taxes and all those taxes. But then you can also take distributions out of the entity, and then you don't pay any tax. Or, well, I mean, you're going to pay tax on it, but it's a capital gains tax, or it's other types of.
So it'll be a lower rate, is what you're saying,
or
right?
ordinary income. So you're not
Yes,
paying. Yeah, it's different types of taxation, but you're not paying the FICA tax, and that's a big deal. I mean, that's over 15%. That you're saving. So those are just some kind of like high level. I mean, obviously, there's a lot of ways we can get down into the weeds with those types of entities and the way that they can save on taxes. But
yeah, I would just jump in and say, when I moved to Lincoln, I actually met with a gentleman who's a CPA who helped me with this. I had been filing as a sole proprietor. He took one look at my tax return, my 1040, and he's like, oh man, yeah, I can help you a lot. Because again, you can set this entity up, and now I can split my income between the two and avoid the payroll tax is what I call it, right? Like the Social Security, Medicare type taxes. Still paying myself what we call a reasonable wage, but you avoid that 15%, that's huge.
Yeah.
It still flows to my individual return. At S Corp, you file a separate return, but you'd still pay as an individual. It's what's called a pass-through entity.
Yeah.
Another thing I'd mention, it's worth bringing up, there was a recent bill passed in Nebraska when it comes to paying taxes as a PTET, pass-through entity tax. That it could be a game changer. We'd have to do a completely different show on that, but it'd be another reason to give us a call.
Gosh, so much to know. And I just want to set up for folks too to understand, you all are not CPAs, you're not accountants, but you are financial planners that engage in strategic tax planning, and that is a different skill set than simply preparing taxes. And we need our CPAs, we love our CPAs, but you work in tandem to help build these solid tax plans for your clients.
Right. Yeah. We talk a lot about, most CPAs are looking backwards.
Yes.
We're looking forwards, and so that's the main difference. And And so when you have somebody looking backwards to protect you and you have somebody looking forwards to protect you, that's the right team that you want to have.
Then
right?
you're covered for sure.
Yeah.
Well, and we always say that oftentimes when it comes to taxes, it's like you're playing a game that you've never been given the rule book to. Only by working with professionals who are engaging in strategic tax planning, that's how you're going to be able to know the rules and be able to figure out how you can save your tax bill in retirement and beyond. So we encourage you, if you would like to receive your complimentary written financial plan, all you need to do is call 866-256-7778, or again, you're welcome to scan that QR code in the bottom right-hand corner, and that will get you connected as well. You'll be able to come in, sit down, meet with the team of Stonebridge Wealth Systems, and be able to build your comprehensive written financial plan, and as part of that, incorporating these tax saving strategies as well. Stay with us. We'll be back after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was going to sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm going to be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you want to bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for him. And so, you know, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money, and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back to the Retirement Compass. I'm your host, Kristen Oakley, here with both Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Systems, based right here in Nebraska. Today, we are peeling back the curtain and sharing several tax-saving tips for you, not just in 2024, but beyond, because as we have established, being able to lower your tax bill in retirement is so key to the success of your retirement plan and making sure you don't outlive your money. I know that we talked about this a little bit in the last segment. You work with a lot of small business owners in Nebraska. What are some other tax-saving tips? Because I know you guys have a lot of strategies that you're able to employ for those clients in particular.
Yeah, you're right, we work with a lot of small businesses. One of the biggest small businesses that we work with is farmers in Nebraska, and I'm sure that's hard to imagine, but I have never met a farmer that likes to pay taxes. I don't know that there's one that exists.
Does anyone ever really like to pay taxes?
Yeah.
Let's just be real, right?
Yeah, literally, I
am too, yes.
I think they're allergic to it. I think you're right, Tim. But so a lot of the times they're looking for ways to avoid paying taxes. And one of the big things that we recommend a lot is you can hire your children, as long as they can actually perform some function on the business or in the business. And so with farms, I mean, a lot of kids are driving and tractors and doing things by 8 years old.
Oh, my husband started driving a tractor at 4. True story.
Yeah, so
there you go.
And that's not uncommon. And so the nice thing for a family farm is you could pay your kids. Right. So if you have 3 kids, you can pay them up to $14,600 this year in 2024. And the nice thing is the standard deduction is $14,600, so your children are not going to have to pay taxes. But you can also look at maybe making Roth contributions because they have earned income. And so the family farm, or any business really, if you have children that are able to work in your business, you can pay them up to $14,600 without creating any taxable liability for them. But you're also getting the deduction for your business. So you're not giving money to the IRS. You're putting it, or saving it or keeping it in your family.
Right. And stuff like that is so simple. But to your point, a lot of folks aren't aware of it, and we're not talking about avoiding tax and not paying what you legally owe. These are legitimate strategies built into the tax code that a lot of people just aren't aware of. And I know you've got even more to share. We only have a couple minutes left, but what are some other ones that you want to hit on today?
Yeah, so let's just stick with small business owners. A great one is what we call a solo 401k. So think of like, a lot of times we'll run into this with, again, farm operations where it's a husband and wife, maybe it's a C Corp or an S Corp. Used to be that C corps were more kind of in vogue. Now we mainly see these S corp, subchapter S corporations. But you can have a 401k, and it's a two-person 401k, and the regular contribution limit still applies. So let's say they're 50 plus in 2024, they can do $30,500. But we talk a lot about where tax rates might be going in this show, right? And how right now tax rates are some of the lowest rates in history. Just after World War II, the top tax rate was 94%. It didn't drop below 90% until 64, 65. So in a 20-year period that the top tax bracket was over 90%. So if we're concerned about rising taxes, a lot of people will say, well, let's pay the taxes now, pay at a discount while they're on sale. Well, this strategy is called a mega backdoor Roth IRA, or excuse me, mega backdoor Roth conversion, where you could put, let's say, $30,500 per person into a Roth 401k. You then make a after-tax contribution to the 401k, if your plan allows it, of $46,000. You immediately convert it to a Roth. You got to make sure your plan's set up properly for this. The result is $76,500 of Roth money in 1 year for one person. You can do that per person. That's called building generational wealth, because rates could go back to those 1943, 44 levels.
Right.
You'll never pay taxes on this money again. So it's very powerful. So I think what it comes down to is who's minding the hen house. Oftentimes we focus so much in our lives on growing and accumulating, and how do we get more
assets? How do we, right?
Right, and I was going to say my analogy is chickens producing more eggs, right?
Yes.
And we know the most basic axiom of investing is, don't put all your eggs in one basket, right?
Yep.
But we want to make sure that those baskets continue to flourish and populate. And when we focus so much on our lives and we don't have a professional that we can trust in our corner, a fox gets in the hen house and starts having itself to the buffet, and all of a sudden we don't have as much left. That's like taxes. Not paying attention to taxes can be a critical mistake, a fatal error. The good news is the team we have here at Stonebridge, myself and our team of elite advisors and Jeremy, we're going to put a nice, large, high, tall fence around the hen house that you've created. This is your nest egg that you've accumulated. A big, beautiful door is going to be in there so you can get and access that money, but we're going to mind the corners to make sure that things aren't slipping around. There's no tax termites that are eating away at your retirement dollars.
I love that you're so passionate about helping folks not pay a cent more to the IRS than they owe, right? This is why we want you to be able to engage in these tax saving strategies. So again, if you would like help putting together your plan, that number to call is 866-256-7778, or again, you're welcome to scan that QR code and that will get you connected as well. We love you, Nebraska. Thanks for watching. We look forward to being back with you next week.